All right. Hi, everyone. I'm Jorge Sanchez from Physician on Fire. Excited to be with you guys with another webinar. I'm excited about this webinar with Earned because financial independence is a topic that's very dear to our heart. Um, and I always believe in this idea of doctors by doctors. And this is a team that is definitely takes care of doctors. We've worked in for a significant amount of time. Um, Today we have Dr. Alfred Atanda. He's a pediatrician, an pediatric orthopedic surgeon. He is going to give us some insights on how to make this journey for FI just less painful and more meaningful. We got Bill Martin. He's a CFA. He's the Chief Wealth Officer over at Earned. They have an amazing team. And then lastly, we have Nick Gazzarelli. He is a partner and retirement plan specialist over at Earned. And without further ado, let's get started.
Thank you, Jorge. And it is a delight to be a part of this webinar today. I, too, am excited about this topic of financial independence. It's so important for doctors, but yet can be very elusive. And so we're going to be speaking about 4 key topics that's listed on the slide here. I think it's important to begin with what are the challenges that are faced by doctors in achieving financial independence. And after we've had a chance to unpack that, we're going to move into some specific retirement plan strategies that can help increase your odds of achieving this financial independence sooner than later. I'm excited about topic 3 and 4 because that's where we hear from Dr. Atanda. We also have another case study that features a doctor where there are financial lessons learned and how those apply to potentially you. And then looking at some additional strategies beyond retirement planning to help unlock financial independence. I want to first hand this off to Dr. Atanda. I know you're an expert in this space around physician burnout and other challenges that are faced by doctors. This slide here speaks to physicians and money and the complex relationship between those two. Would love to hear your thoughts on this and anything else that comes to mind. Dr. Atanda.
Thanks, guys, and great to be here. And thanks for the great introduction, Dr. Sanchez. You know, in my journey as a pediatric orthopedic surgeon, you know, when I was coming up through my training, I was given all the tools that I needed to make hospitals and other health organizations money, right? I do surgery, I see patients, we interpret tests. And quickly into my practice, I realized that there were a tremendous amount of tools that I didn't have in order to really thrive, grow, develop, both personally and professionally. And in my role as the director of physician well-being at my hospital since 2020, I've realized that financial skills and financial health and financial savviness play an enormous part in the well-being of physicians. As you can see by some of the stats there, how we generate revenue and how we provide value to our organizations is quite important and can dictate the work that we're doing, how satisfied we are with the work, how likely we are to change practices, et cetera, et cetera. And I think, you know, when we talk about physician burnout, we know that it's a systems level problem that unfortunately manifests in individual physicians and other frontline clinical care workers. And for me personally, by going on a journey and really understanding how the financial aspect of my life interplays with my practice and my goals, that was really eye-opening for me because, you know, I spent a lot of time and a lot of energy and a lot of resources devoting myself to my organization, all to ensure that I have financial security. And that's a reasonable thing to do, but when you spend a lot of time and energy, you quickly realize that time and energy is not unlimited. And when it runs out, or the interest runs out, or the spark runs out, now you have a conundrum because all of your time and energy is directly proportional to your financial security. And that's when I feel a lot of physicians have problems, when they feel stuck, when they feel like they don't have any alternatives, when they feel like they have basically one revenue stream and they're not diversified enough to be able to be nimble and flexible and dynamic. So hopefully with this webinar and some of the insights that we present, it can give you all direction and support as to how you can increase your financial nimbleness and dynamic ability, if you will.
Thank you, Dr. Atanda. And speaking of financial security or financial independence, I ran across this quote. Morgan Housel is an author of the best-selling book called The Psychology of Money, and he describes financial independence this way. It's the ability to do what you want, when you want, with who you want, for as long as you want. I think that's a great definition. And then he goes on to say, this pays the highest dividend of anything that money can buy. So as we're thinking about financial independence in this particular webinar, think back to what this quote says. This is what we're aiming toward in all the strategies and all the things that we're laying out. And speaking of strategies, let's hand this off to you, Nick, to take a deeper dive into some specifics around retirement savings, the plans, and what's available for doctors.
Great. Thanks, Bill. And thanks everyone here on the call today. And I'm just gonna, at the beginning, say that I could talk for 45 minutes on this single slide right here. So it's gonna be very high level. And I'm gonna go kind of quickly through it because there is actually a ton of data and discussion that could be had just based on what's on the screen here. So as I've spent the last 13, 14 years or so working almost exclusively with retirement plans, and with that, probably 98% in the medical and dental space, and for many reasons. But the tools in the toolbox, whether you're building an investment plan, whether you're building a financial plan or an estate plan, right? There are many different options available to you, and oftentimes navigating these tools and understanding which option is maybe the most appropriate, not even the best, but just suitable for you could be difficult. And so my goal here in the next few minutes is to kind of give you an overview of some of the retirement tools, retirement savings tools available to doctors and individuals, so that if you're in a space where you're trying to build out your financial plan, you at least know what is out there. And the good thing about any plan is it's evolving. You don't set a plan at 35 years old and that plan still applies at 65 when you're nearing retirement, right? Plans go through phases, and so do retirement savings and other strategies that a doctor may employ throughout their career and retirement. So looking at this slide here, we'll start with the smallest green bars at the top or slices, the IRAs, individual retirement accounts. And these are where most individuals start when saving for retirement. They set up an individual retirement account at the bank or investment house of their choice, and they put away whatever the limit is that the IRS has set that year. So this year, the IRS says you can put away $7,000, and that can either be a pre-tax or a Roth tax contribution. Now, there are restrictions and limitations depending on whether or not you're participating in a company plan or you have, depending on your net worth. But those are the starting points for most individuals. In fact, many people set these up for their children who are, maybe if they're earning a small amount of income, they set these up as saving strategies for their children. Once you go into the workforce, you're now moving into some of these other slices, and we're going to go clockwise here. So we're over at the simple IRA and SEP IRA. These are essentially the first step into what we call the big boy retirement plans. This could be for a young practice who still building cash flow, still building a client base, and maybe not quite ready to maximize. You don't have the cash flow quite yet to maximize your retirement savings, because the IRS says, you know what, we're going to let you save on taxes. We're going to let you put money away and defer it pre-tax. But you got to play by all our rules, including maximum limits on what you can put away, because we don't want you making $500,000 a year and not paying income tax on any of that. You know, the budget deficit, who knows where it would go if they would allow that to be the case. So looking at the simple IRA, this is often the first step for a young practice where a doctor wants to save more than $7,000 on a pre-tax basis, but they're not quite ready to commit to a full-on 401k or profit share or pension type plan, which has much higher limits, but is also more complex, and the reporting and administration on that requires just a little bit of thoughtfulness or outsourcing to a third party. The simple IRA allows you as an individual to put away up to $16,000 as a pre-tax contribution, but there is an employer piece to that. So if you're self-employed and you have staff, by opening a simple IRA, you would be required to give a 2 to 3% contribution to your staff on payroll, and you yourself would also receive that 2 to 3% contribution. So essentially, you're saying, I'm taking my $7,000 contribution and upgrading to $16,000 plus 2 or 3% of my income, but it's going to cost me a 2 to 3% benefit or cost to fund my staff. Okay. And as I go through this, I just wanted to remind or let everyone know, if you have questions that are coming, please submit those, I think in the comments section here. If it's a quick question that I can just wrap into what I'm saying, I'll take care of that now. And the rest of us will take care of it now, but we will definitely have Q&A at the end, and we will queue all those up and go over those at the end here. So that is a simple IRA. Most commonly, you see self-employed doctors who have a small staff looking at this option early on in their career because it increases their savings without costing too much to fund the staff and very little administrative costs to do this. Next is the SEP IRA, and I'm not going to go too deep into this because this is best suited for a self-employed doctor without staff. And the reason being is it's pretty straightforward. You can put away up to 25% of your income, but whatever percentage you give yourself, if you have any staff, they get the same percentage benefit. So if you make $100,000 and you want to put away $25,000, which is 25%, you have 2 staff that collectively make $100,000. Guess what? They're each also getting a 25% contribution funded by you, the employer. So that's really meant for self-employed, not meant, it can be used for anything, but it's most commonly adopted by self-employed doctors who want a simple, an easy, I guess I won't use simple because I have another plan here called simple, an easy plan to administer without the complications of a 401k filing and other small nuances that come as we move around this pie chart. The last two should be a doctor's goal to get to these to participate in these last 2 options because they have the highest contribution limits. There's significant tax and income planning strategies that can be utilized and essentially started from these 2 buckets here. And I think, Bill, you might talk a little bit about diversification of the types of money that you have and how that's beneficial. So the 401k plan is very well known. This also, I didn't put it on here, but this also could be a 403b plan or a 457. Other types of larger retirement plans that are most commonly used by employers. So whether you're an owner doctor, you're an associate doctor, chances are now or in the near future, you're going to have access to a 401k plan. And the benefit of a 401k is it really allows you to put in higher amounts, and it's fairly well understood. And there's the options for pre-tax or Roth after-tax contributions. So this year, 401k plans, you can put away up to $23,000 as a 401k deferral or a contribution. Now that can be pre-tax, so you're getting a tax deduction today at the Fed and state level, or it can be Roth after tax where you're not getting a tax deduction today, but it grows and can come out tax-free in retirement. And one thing to point out here, I get this question a lot, is there are no income limitations or restrictions to participate in a Roth 401k. Roth IRAs, yes, there's certain restrictions or certain hoops you have to jump through to make it work, but the Roth 401k does not care, okay? Then on top of that, you can tack on what's called a profit sharing or a match or other types of employer contributions. Those are pre-tax 99% of the time. And that gets you another up to $46,000 that can be put into your account above and beyond the 23. So if you're an owner doctor, you as an employee of your S Corp or self-employed business, put away $23,000 of your income. And you as the business owner, the employer, put away the $46,000 to your account to get your total annual contribution up to $69,000 for 2024. Now, if you're age 50 or better, there's something called a catch-up. So the contribution limit's actually 76,500 this year of what can be put into your account. This does have considerations like a simple and a SEP, where if you have staff, they are required to receive, let's say, a match or a profit share if you are giving yourself one. But you're allowed to design the plan much more creatively, to where an owner doctor maybe can give themselves a 20% profit sharing contribution, and depending on some of the administration, give the staff a 5 to 7% profit sharing contribution. And the IRS will say that's not discriminatory. It passes all of our rules and ratios. So you're allowed to do that. It doesn't have to be a uniform percentage for each individual employed by the practice. Okay. And another important thing here is if you're part of a medical group that has different specialties, or if you have allied health professionals or nurse practitioners, and you have office staff, and you have different classifications of employees, you can design a 401k to provide different benefit levels to each of those groups. Something we see quite often in the 401k space. And last, I won't touch on this too much, but I just want you to know that it is there, something called a cash balance plan. The biggest adopters, or the fastest growing adopters of this type of plan, are medical professionals. And the reason is that it is like a supercharged profit sharing plan. The employer funds a set dollar amount, or it provides a benefit of a set dollar amount, goes into a pension type account where it grows at a modest or conservative 4 to 6% per year, because it is, think of it kind of like a deferred comp type plan where it's going to grow to target to meet and beat inflation. But the biggest benefit is that pre-tax benefit that you get today. If a medical group is putting in $200,000 to fund cash balance plan for a few of their clinicians, that's a $200,000 tax deduction that gets to be realized today. So it is pre-tax only. The annual limits are actually based on age. If you're 35 years old, you can receive a benefit of about 50 to 60,000, maybe a little bit more per year. If you're age 65 and you're just starting this plan, you can put away more than $200,000, close to $300,000 per year into this account, depending on your income, making a few assumptions. And the reason it works that way is the IRS says in a cash balance plan, we're not going to limit how much you can put in each year. We're going to limit how much you can take out at normal retirement age. We're going to define the benefit, which is why it's called a defined benefit plan. So if you're age 65, you need to put in a lot more money today to hit that maximum benefit that you can take out. Whereas if you're age 35, well, guess what? This is a good problem to have. If you put in $60,000 per year for the next 20 years, you're going to hit that limit by the time you're age 65. So a very powerful plan that some medical professionals, whether self-employed or part of a group, tack on top of a 401k plan to supercharge their savings for a certain period of time.
Hey, so Nick, before moving on, one thing that I would point out too is I'm just looking at this, and it appears if you're an employee, maybe there's fewer options than if, let's say, you're a practice owner. But one thing that's probably worth noting, and you called this out on the 401k plan segment that you talked about. So let's say somebody's working at a not-for-profit hospital. They have a 403B option with the same limitations that Nick just said. That hospital may also offer a 457B plan. Nick, do you mind commenting on that? Because there's actually some doubling opportunities that's for the employee. I think it's an important consideration too. Maybe just hit that quickly and let me know when it's time to move to the next slide.
Yeah, so that's a good point. So that 23,000 green slice in the 401k section applies to 403Bs as well. So if you're a 401k or a 403B participant, meaning an employee who has access to that plan, that's how much you get to put in. You don't necessarily get to double dip. Like you can't work for one medical group in January, put in 23,000, work for another medical group in February, work for a hospital in March, and just supercharge your savings. They won't let you do that. But there are certain plan types that are held independent of each other. And so, Bill, I think that's kind of what you're suggesting there is something like a 457 and so in certain employer contributions. They don't have to look at what you've funded to other plans to allow you to really double dip your savings and save extra. So that's the employee piece that is important to comment that there's not really a gaming ability to game the system a bit to increase your savings. But some hospitals, some non-for-profits will offer multiple savings vehicles, a tax savings plan, all these different things that really allow you to maximize savings above and beyond just the 23,000 sliver that I've put in there. Yeah. Great. Thanks, Bill. So let's just quickly, we have the tools in our tool belt. And how are we going to build a plan using some of these tools? And this is a quote that I think is actually many of you may have seen. Rich Dad Poor Dad is I think a well-known book out there in the finance world. So you may have heard this. Financial freedom is available to those who learn about it and work for it. And I think it earned. And you'll see Thomas Dahl on my wall back there. We are a division of earned. Been around for about 60 years. And our number one goal, and we joke about this when people talk to us all the time, be like, you know, Nick and your team, how come you guys have so much success and with your physician group? And it's because we like to educate, right? So our goal is to, if you don't know what's available to you, how are you going to go get it? And so that's kind of what I take this kind of thought of, you learn so you can execute. I wanted to go over a specific case study here on the next slide. Dr. Nestor Carras couldn't be with us this morning here, but I've worked very closely with this physician for a while, and just wanted to use this to kind of wrap up everything I've gone over for the last 10 minutes here to see, okay, we know what the tools are. Let's see how one could execute and use these tools throughout their career, not just today. So Dr. Nestor Carras is a business owner on the West Coast here, and really started his self-employment, whether he was incorporated or individual, doesn't really matter. And started seeing some income, started to see some success. And first thing that happens, not the first, but one of the first things that happens when you start to see success is you start to see your tax bill increase. And so that spurred the question for Dr. Carras: I'm earning more money, but my net take-home pay isn't growing as fast as I thought it would. Right? My profit and loss statement says I'm doing very well. I just don't feel it on a day-to-day basis. And so that posed the questions of, how can I be more creative, thoughtful, and efficient with my personal financial planning and savings? So we started here with this first one, a profit sharing 401k plan, where Dr. Carras put away that $23,000 per year, and that amount changes every year. But he put away that $23,000 per year to get a federal and tax deduction today. Then he said, now I want my company to provide a profit sharing contribution to all my employees and myself. And so he gave himself the $69,000 pre-tax benefit, deferring that income so it's not taxed today. And he also provided a meaningful benefit to his staff, maybe in the 5 to 7.5% range, that was part of their compensation package, right? So it is a win-win there, to where maybe he built the compensation package, so between benefits and insurance and wages, that it was a competitive package and allowed him still to maximize his own retirement savings. Next, we talked about with Dr. Carras the idea of Roth IRA savings, but he's not eligible to do that. Makes too much money, already has a qualified plan. IRS says, sorry, you don't get to do a Roth IRA directly. So we employed what's called a backdoor Roth IRA, where he made sure any of his other IRA dollars were rolled into his 401k plan. And he implemented a strategy that involves making an IRA contribution, realizing it's not deductible because the IRS says he makes too much money, so converting it to Roth the next day. And now it grows tax-free and he gets to take it out tax-free in retirement. Okay. Next, being self-employed, he realized, hey, my spouse actually works in the office and she is providing actually bookkeeping and front office support for the office. So we reviewed opportunities to add the spouse to payroll, and guess what? She gets to put away $23,000 per year into that 401k plan. Then we did the cash balance plan, where we supercharged his retirement savings. In his peak earning years, we increased his $69,000 benefit to, let's say, $180,000 or $200,000, whatever it is that we wanted to do to really start to supercharge that pre-tax benefit. And now we're actually in this last stage with Dr. Karras where he's saying, you know what, maybe I want to sell half my practice soon. Maybe I want to retire in the near future. We're going back and redesigning the two retirement plans to maybe adjust the contribution levels so that when he sees sale proceeds from that practice and he's still earning some income for that last year where he goes down to part-time, that he's not getting hit with an outrageous tax and capital gains bill, that maybe we're able to defer a larger chunk of that in these last few years. So he can retire with some, what we say, retire with finesse is really the goal there. Okay. And so with that, I think, Bill, I'll hand it back to you here. I think there's a few other strategies you wanted to talk about that can really supercharge what we've been talking about so far. So let me know if there's anything I missed here. Otherwise, it's all yours.
Yeah, thanks, Nick. And as you suggested, really wanted to also highlight a few things outside of the retirement plan arena that still allow you to really make progress on that journey toward financial independence. This slide here shows 6 different things that may occur during the course of a physician's career and different strategies that can be deployed. There's a lot more than are represented on this slide. This is just representative. And because of time, I'm just going to pick 3 to take a little deeper dive into. The first one is the very first one outlined here. It's develop a financial plan. Think of this as your financial blueprint, financial roadmap. And as you're making this journey toward financial independence, for those that don't have a plan, it becomes very difficult to see the success and the outcome that you want. And what we have observed is doctors that spend the time to develop this financial plan, often in partnership with a trusted advisor, increase their odds of achieving this success materially because there's a clear plan in place, there's strategies to accomplish that plan, and there's benchmarks to be able to determine as you progress throughout this journey, are you on track or not? So encourage everyone on this call. If you haven't developed a financial plan, please do so. And if you have one, don't think of this as just something that's been done once and it's finished and it's placed up on a shelf, never to be revisited again. Life is dynamic. Your career is dynamic. That is why your financial plan needs to be revisited on a periodic basis to make adjustments as those things in life come up. The second thing is really around that I wanted to highlight is this invest in taxable brokerage accounts. And similarly, this other idea of exploring backdoor Roth IRAs and mega backdoor Roth IRAs. The concept between both of these is what, Nick, you referenced I'd be speaking about, tax diversification. So it's important to take full advantage of the retirement savings vehicles that you have, whether you're an employee or a practice owner. And once you've had a chance to maximize these, it's important to begin thinking of diversifying those additional savings into other tax buckets. So for example, investing in taxable brokerage accounts as a way to continue to build wealth. And as Nick referenced, the mechanics behind a backdoor Roth, and there's also a concept that's known as a mega backdoor Roth, to be able to begin saving dollars into these tax-free accounts. So what you end up, it's a principle of diversification that's in, let's say, investment management, diversify across different asset classes. It's a very smart principle, but it's also a really smart principle to diversify across these account types and not to just be lopsided in one versus the other. One of the reasons why is when it becomes time to tap into these portfolios, into these accounts, it gives you a lot more flexibility in where to best source those, how to minimize taxes once you're in retirement, and really extend out the longevity of those dollars by having a well-diversified taxable strategy in place as well. This next slide is probably one that I'm the most excited about for this audience. Just recently, we launched an app that Earned is doing in partnership with Physician on Fire. This app brings together all of your finances in one place. And I want to call out, this is a free tool Similar to what Nick was saying, education and equipping doctors with tools to help them on this journey is really important. And this is, in essence, kind of our gift back to you to help make progress on this journey. And a couple of highlights of what this app provides. It really does give you insight to know where your money is going very clearly. You can set goals and track progress. Similar to what I said, developing this financial plan, this can be a tool to help you start on that particular journey. Another thing is it explores through AI the ability to personalize and your spending trends and to know how to really maximize those savings. And lastly, there's access to the Physician on Fire content that you love in a well-organized way that you can just at the click of a fingertip have all of those resources available. So I encourage you, go to the App Store, download this, scan the QR code if you'd like, and it takes you directly there, and begin using this tool as you move onward toward financial independence. Dr. Tanda, let's transition back to you. And I know this picture is a bit of an eyesore, so I'm really curious to hear why you wanted to include this in the presentation. So back
Yeah,
to you.
no doubt, Bill. Thank you. As you can, as you can see, this idea of a cluttered basement or attic is kind of how I always saw dealing with my financial issues and my financial problems. Right? I'm an orthopedic surgeon. I was trained to do that, but thinking about tackling some of the issues that Bill and Nick have highlighted, specifically Nick's interpretation of slide 9. Even though I've seen it before and I've been in this space, my palms are still sweating thinking about that, because when I think about my own financial journey, I get so overwhelmed. Just like if somebody told you to clean out this attic, like you don't know where to begin, you don't know what to do. And it's just so much easier just to close the door, forget about it, and go do something else. And that's literally what I did most of my life. But I always tell people, like with any big task like this attic or climbing a mountain or running a marathon, it's one step at a time. And that's really the only way that you're going to get from beginning to end. And even though it seems very daunting, just taking it piece by piece, getting those small gains, those small wins is huge. And I think, I want to share just my personal story. As Bill and Nick have alluded to, having that plan is huge. And for me, I started to realize, when I talked to a lot of other physicians and looking at my own practice, I needed to diversify myself because I never really even knew how I could, quote unquote, engage in passive revenue. Everything that I did was active revenue. As I mentioned before, I traded my time and my energy for revenue. And I had one source of that revenue, and that's fine. But if there's an issue with your job, or you don't like it, or you're not as satisfied, or you're not as fulfilled, or life happens and other things get in the way, we talk about those golden handcuffs and the golden shackles when you're just depending on one stream. So you really do need to know that physicians actually have a lot of knowledge and experience and expertise swirling around in their brains at any given point. But understanding and leveraging how you can get that knowledge from point A to point B for your benefit financially is what's huge. So understanding e-consults, second opinions, telemedicine, being a public speaker, working for an insurance company, doing legal work, there's actually lots of ways to diversify yourself. And once you understand that, it opens up a whole new world as to now how you can manage your time and your energy efficiently. Because as you know, if you're kind of have all your eggs in one basket in an active revenue fashion, when you stop working, so does your revenue. And then you quickly run out of time and energy to be able to enjoy the revenue that you're making. So for me, I'm into digital health and different things. So I started investigating all of these other opportunities in conjunction with the folks over at Earned who were helping me incorporate those other opportunities into my financial plan, because that really put the momentum back into my favor, and it put me into the driver's seat to be able to have control over my time. And I think that's one of the biggest factors in terms of physician burnout that's inextricably linked to finances is that we don't have much control over our time. It often does get dictated to us. And when you can maximize and control how you spend your time on a day-to-day basis, that really opens up a whole new world as to what your life can offer you, but also all the revenue that you've generated can offer you as well. And you can see here, for me, these are some of the things that my Earned Advisors has done with me. But it all started with me digging deep, thinking about what I wanted, what meant the most to me, what was valuable to me, and how I wanted my career to go. And that's something that a lot of us don't know that we can do. We don't have the skill set to do it. It may make us uncomfortable to do that, but it all starts within, and thinking about what means the most to you, and then obviously finding those professionals that can help you maximize that financially as much as possible. So I'm going to wrap up there, and I wanted to again reiterate from my experience with physician well-being and physician burnout. Whether you realize it or not, it's not just your day-to-day practice that contributes to that. I think your financial savviness and financial health significantly dictates your ability to generate revenue and provide value to your organization and to yourself if you own your own practice. And I think understanding the ins and outs of finances, and leaning on those professionals who do it full time to take some of that cognitive burden away from you can be very helpful. So hopefully the kind of landscape that we just painted with this webinar motivates and inspires you to think about what you can do for yourself.
Thank you, Dr. Atanda, and for your willingness to share your own journey. There's so much insight, I think, that can be gleaned from what you've walked through. Hopefully that's been instructive and informative to the audience. And speaking of the audience, feel free to go ahead and drop in the comment section any questions that you might have, and we'll try to either tackle them on this call or follow up afterwards. I did have a few questions here that I wanted to maybe take a deeper dive in as we're waiting for the audience to drop in some additional ones. But Nick, let's direct this one to you. If I were to open up one type of retirement plan, could I later switch to a different type of plan?
Yeah, so that with the case study that we did with Dr. Karas, I think that's a perfect example to kind of answer that. And the short answer is yes. With certain restrictions, you can kind of change whenever you want, as long as you don't exceed limits, as long as you essentially don't double dip on certain contribution limits. But oftentimes what you will see is you'll see a doctor beginning their career, saving on their own inside an IRA, joining a practice as an associate, and saving in that maybe SEP IRA or simple IRA, receiving a benefit because it's a young practice, or maybe even a 401k at that point. Then maybe becoming a practice owner, at which point they change up the retirement options to offer a different type of plan, and getting to their peak earnings year, tacking on a cash balance plan on top of that. Then the opposite occurs. They go down on retirement track, start to wind down. Maybe they shut down the cash balance plan because they don't need it anymore on the 401k. So it's kind of a cycle, and they navigate up and down the set of options as their career or their financial plan tells them it's time to do so.
Perfect. Thanks, Nick. Dr. Atanda, let me bounce this question to you.
Yeah.
You've referenced, the use of a financial advisor. Why should somebody on this call consider hiring an advisor? And maybe tied to that question too, if they do hire an advisor, what are some important attributes to consider?
Yeah, I mean, I think of myself as a smart person, but obviously there are a lot of blind spots and gaps that I have in my knowledge, specifically finances. And I think we get very comfortable in the fact, as we're physicians, that we spent most of our lives, if not all of our lives, learning and training, that we feel that we can kind of take on a lot of different things. And we may be able to kind of read some books and look at financial planning for dummies kind of stuff, but that takes time and it takes energy, and we're not the experts. So I think leaning on a financial advisor serves two purposes: to ensure that you're maximizing the energy and effort in a financial way that you're putting in, but also taking some of that load off of you. I mean, there's so many things that we're responsible for, both personally and professionally. It's just one more thing to worry about. So if you feel comfortable, I think finding a good financial advisor group is key. And the second thing on top of that is to really think about your connection and your relationship with these people. I would, look at 2, 3 different firms, maybe even 4, and seeing where your gut tells you to go. You have to have a good rapport with these folks. There has to be a good bond and connection. You have to feel free and comfortable reaching out to them, emailing them, texting them, all that sort of stuff. Just like with any relationship in life, it has to be a good fit. And then obviously you want to try to gravitate towards folks who are in the space of healthcare and dealing with physicians and dentists and pharmacists and other healthcare folks, because there's going to be a lot of things that apply to us that may not apply to other professionals. So that would be my advice to you all, and kind of the success that I've had in my short time working with Earned.
Yeah, thank you, Dr. Tanda. I would maybe add to that too, if individuals are looking for an advisor, a couple other attributes that are important. I agree with everything that you just said. Another is this concept of being a fiduciary. You can hang your shingle in this industry, unlike maybe the medical profession, where you call yourself a financial advisor, but there could be a lot of different standards that are out there. So working with a fiduciary, somebody that's going to be operating in your best interest, is a really important consideration. And so make that part of the inquiry as you're, potentially looking at a couple of different firms to engage in this process. So it's a really important piece that I would consider that's a part of this. Let's move on to a question that came in from the attendees. And Nick, I'm going to direct this one to you. So it says, for a single member LLC, would you rather do a simple or SEP or both? 16K plus up to 69,000 was part of that question. How would you address that particular comment that's come in?
Yep. So that's going to come down to essentially 2 considerations. How much income are you making? How much revenue do you see, or net income are you making in the LLC? Are you taking a W-2, or are you being taxed on a Schedule C? Are you essentially self-employed, or did you get taxed like an S Corp? First off, as a business owner, you can't offer both in the same year. So that's off the table. You can't do them at the same time. The IRS says, hey, you're trying to do a 401k by putting these 2 plans together. We're not going to let you do that. Now, if you're an employee and you happen to be self-employed and also an employee of another group, and they happen to offer one or the other, you can participate in both in 2 different locations. But you as an owner of an LLC cannot set up both in the same year. So it's going to come down to your net income. Is 25% of your net income enough savings for you? Does that hit your annual savings goal? And if the answer is yes, STEP is a great option because it's easy to administer. You just put in that contribution as a pre-tax, and you take that deduction through the business, whether it's on your Schedule C or your corporate return, depending on your entity tax structure. If that is not enough for you, if you want to do more, let's say you just have low LLC income, if 16K plus 3% of that net income gets you to your goal, then you know your answer. The simple is going to be the direction that you go. Now, if neither of those gets you to where you want, which I think that is kind of what this question is alluding to, that, hey, I want the 25% employer contribution, but I also want my employee deferral. That's really where you look at something like a 401k. And the mass market has coined this term solo 401k. In the code, that actually doesn't exist. It's just a 401k with one person in it. But that's what a lot of self-employed individuals will do, is they'll go the 401k route where they will put in 23,000 plus 25% of their net income. And administration's a lot easier if you're the only person in the plan. In fact, administration is very easy if there's less than $250,000 in the plan in assets. But even when it does cross over 250, it's still very straightforward. So I hope that answers your questions. Those are actually the 3. And based on the way the question's worded, I'm thinking the 401k would actually be the solution to be able to take advantage of the employee deferral plus the 25% employer contribution limit up to 69,000. I did see another one come in here. Did we want to take a look at that one?
Yeah. Nick, do you want to take that, or would you like for me to?
I'll jump into that real quick, and then Bill, you can add some
Okay.
flavor to it.
Okay,
So,
yeah,
question-
I'll read it real quick and then hand it to you for the answer and jump back in. So the question is, I had a Roth IRA that my employer contributed to. The money the employer contributed was pre-tax. I've since left that job. Would you recommend rolling the entire balance to my other existing Roth, or roll over the pre-tax amount to a 401k and my personal Roth contributions to another Roth? What implications would be important to consider in this case?
Great. How about I say what you can and can't do, and then Bill, you can add some considerations in that. So my hunch is that if you had a Roth and the employer contributed pre-tax to it, is you actually had a Roth 401k, because an employer can't put pre-tax dollars into a Roth IRA account. That's just not allowed. So if that's the case, it's probably a single account, and maybe there's two buckets of money in there. One says Roth and one says profit share or match or something else. You have two options. You can roll the entire balance, both Roth and pre-tax, to your current employer 401k, assuming they accept the rollovers, which almost all of them do, but it's worth double checking. The benefit of doing that is just having it consolidated in one place for when you're doing asset, you're building an asset, a portfolio, it's all in one account and you don't have to do it in two separate places. You could do what you hinted at, roll the Roth to a Roth IRA and roll the pre-tax into the 401k. The only consideration with that is once the Roth is out of the 401k world and it's in an IRA, it doesn't get to come back in. Now, there's nothing wrong with that. It can just live outside your 401k assets. But if you happen to start contributing new Roth 401k dollars to your current employer, you're going to have two different buckets of Roth. And if you're working with someone, they can manage that no problem. If you're doing it yourself, you got to be a little bit more thoughtful with your investment strategy. Tax-wise, if you're using the term rollover, meaning it's going retirement to retirement, there's no tax consequence in either case. There is something about resetting a 5-year clock, but I believe that'll apply regardless of where you roll the Roth to. So Bill, is there anything you wanted to add to that?
No, I think that's a good overview. The only piece that I would add is you may be more limited in your current 401k lineup of how you want those dollars managed than if it was outside in a personal Roth IRA. Just another consideration. I think in questions like this, which are really important considerations, back to this concept of navigating with a professional that understands the different options, this can really help provide clarity to your particular set of circumstances. I'm going to quickly, one question that I wanted to get to here, but before doing so, I'm going to flip back a few slides. I was getting some comments on just making sure we get access to this particular slide on the Earned Physician on Fire app. Again, I would encourage you as a takeaway from this particular webinar, scan this QR code, download this from the App Store, and begin really keeping track of your financial journey in a way that can help you unlock that pathway toward financial freedom. The last question that I wanted to touch base on was how important is it to be saving for retirement outside of my employer-sponsored retirement plan? What are strategies that should be considered? And Dr. Tanda, a phrase that you mentioned, a lot of things are outside of your control. I wanted to answer this by really focusing in on what are the things from a financial aspect that are within your control, and those are areas that are important to focus. So the first thing I would just say is make sure you are saving adequately to fund the things that are going to be important to achieve financial independence. If everything that's coming in, even if you're an incredibly high income earner, but it's being spent on things that are not growing your wealth over time, it's just you're a high income earner, but you are not a wealthy individual. And so it's really important to have the discipline as those dollars come in to carve out a sufficient amount to begin to build and continue building this wealth. This is clearly within your control, but just because it's within your control does not mean it's easy. And that's an important consideration. The other thing that's within your control to some extent is the tax considerations. And we have found physicians and others, medical professionals, that just see so much of those dollars coming in that just go out from taxes. But there are smart strategies that can be deployed, ranging from deductions, the way that you classify this income, whether it's 1099 or W-2, and other considerations. And then there's how does this tax implication marry into the investment management? And things like tax smart investing by capitalizing on tax loss harvesting, tax diversification that I mentioned across accounts, asset placement, and another strategy known as tax smart withdrawals. Combining those together along with deductions gives you a great way to further control and minimize that tax liability, so there's more dollars for you to grow your net worth over time. It looks like maybe there's one more question that came in here. Let me make sure I hit this before we wrap up. The question is, and Nick, I might hand this off to you first as well, and then I can tag team, but what kind of retirement account setup do you recommend to someone who has a 401k from an employer and additional income from locums? How would you answer that question?
Yeah, and I'll try to keep this more educational than advice, since I don't know, the details behind the question. But really, what's going to come down to is similar to the first question we got. Was it's going to come down to how much are you looking to save outside the plan, and how much income are you seeing outside of your employer? How much locums income are you realizing? Because oftentimes a SEP is something that would be great, where you can put away 25% of that outside income as pre-tax. It's not a 401k deferral, so it's not going to hit the limit of the 401k, or it's not going to be impacted by the 401k contributions that are already being put away in your employer plan. So that's often a great vehicle. And then separately, the other question is, do I actually need the pre-tax deduction? Because in some cases, if you have significant pre-tax savings elsewhere, you may be dropping your tax bracket to a point where it may make sense to take the tax hit today and start a taxable savings plan, or do a backdoor Roth, or do these other strategies to diversify your taxes, right? Diversify your assets so that you have a nice pot of pre-tax dollars, tax-free dollars, and taxable dollars. So that way in retirement, you can draw from all three of those buckets to be tax efficient in your cash flow strategy.
Nick, thanks for taking that question, and thanks to the participants for dropping these in. And I'm sure there's probably many more questions that maybe asked in a different form would be better. And so what I do want to wrap up is just a big thank you from the three of us. You see our contact information. Feel free to reach out if you have questions. More than happy to answer those. Dr. Sanchez, really appreciate the opportunity to be a part of this webinar, and we'll hand this back to you.
Sure. No, this is a great webinar. Really learned a lot. One of the things, I guess, the big takeaway from this webinar, I reflect back when I was a independent contractor before I sold my company. Actually, Dr. Tanda, it resonates with me that you did entrepreneurship and you started a digital health company. I did the same. But before that, I was a locums and I traveled as a hospitalist in New Mexico, Arizona, Florida. And I would have lunch with a lot of physicians, and I kept seeing this story of the golden handcuffs repeated in different ways. And it was this, and I would ask, these folks who are my peers, just like if there was some element of diversification of their income streams, and there was very few instances of that. And I think the point of that is that as physicians, like you said, we think we can do it all, and we have these egos that say, hey, we've gone through a lot, we can do it. We have this like can-do attitude, and I think that sometimes it puts us in this risk where we get overwhelmed and we're frozen into inaction. And I think that brings us to what the point of this webinar is, that one of the elements is, as doctors, we consult in a heartbeat. Anytime there's a risk to our patient, we consult someone. We consult a cardiologist, we consult a pulmonologist from, let's say, from pre-op point of view, and yet we don't consult people on the health of our own our own finances, which is really interesting. I see this sense of reluctance and this do-it-yourself attitude that definitely doesn't help. And I think that's the vision of Physician on Fire, is to get, personal finance is it's very personal. Everybody has different journeys to financial independence. And one of the main reasons we're excited with EARN is because they bring a new, fresh look at this idea of finance, especially to the unique problems that doctors have. And there's this whole thing in the ICU, on the floors, wherever, if you can't measure it, you can't manage it, right? And where we're excited about the mobile app that we actually worked with EARN to design and have the features, was if you could put something in your pocket that you could, all your finances, so you could just, in the middle of rounds, you're having a break, you're having lunch, you just whip it out and you look and you see what the health of your finances are from a global point of view. That is what I'm excited about with this mobile app. So if all of y'all can just take a chance to look at it, download it, we can flash the QR code if you want. But I think, the goal of EARN and Physician on Fire is to put tools in your pockets, literally, to get you to reach that journey in an easier and a less stressful way. And again, part of physician burnout is finances, believe it or not. It's not just the hours. It's just the fact that your ROI, what you put in doesn't exactly match what you put out. So with that, I just want to thank Bill, Nick, and Dr. Atande for being on this call. For all y'all in the audience, look out for an email from EARN. There's going to be a link for more information, a link for this webinar if you missed anything or if you came in late. And again, thank you all for being here and participating in this webinar. You all have a great day.
Thanks, guys.